Hey, it's time for the Financial Procast. On today's show, Warren Buffett reminds CNBC, who's your daddy? FINRA does something that actually makes sense. Investors tell the world they aren't all that happy with their advisors. And has your advisor become oddly obsessed with mutual funds and lending products? We might have an explanation for that. All of that right now on the Financial Procast. The Financial Procast, Monday, December 17th, 2012, Episode 16. If we don't have it, you don't need to sell it. Web hosting for the Financial Procast is brought to you by The Insurance Pro Blog, where insurance gets demystified. Online at theinsuranceproblog.com. Hello and welcome. This is the Financial Procast. It's Monday, December 17th. This is episode 16. I am Brandon Roberts.
And I am Brantley Whitley.
And Brantley, this last week, we had what I thought for a minute was going to be the greatest breakup in the financial planning world or the finance world I've ever known.
Really?
Yeah. CNBC was saying bad things about Papa Buffett.
They obviously forgot where their bread gets buttered.
I know. I mean, these guys have been in countless interviews, like at his house, and I'm like, really?
Becky Quick, you know, the redheaded lady.
Yeah.
Oh, I mean, he loves Becky Quick.
Yeah.
She flies on his plane with him and goes to his whatever, eating breakfast with him in Omaha and all this sort of stuff. So, yeah, that was a bit surprising that they would be so blatant to come out and badmouth Papa Buffett.
So, for those who don't know, it was actually Gary Kaminsky who was on CNBC criticizing Warren Buffett for the buyback, the $1.2 billion buyback, which was 9,200 shares of Berkshire Hathaway Class A shares, for an unnamed investor. It was actually this person's estate. And actually, the criticism out of Gary Kaminsky was that this move was planned at a time, the end of 2012, to avoid specifically the capital gains tax that is going to increase come January 1st of 2013. So
and that the whole thing was hypocritical for Buffett to participate because he's been such an advocate for the wealthy paying higher taxes and all that sort of stuff.
Exactly. However, it turns out, as Warren Buffett was very quick to point out in an email sent to CNBC, that he was purchasing shares from an estate. And being purchased from an estate, there's a step up in basis, and so there really is no capital gain tax avoidance there.
Right. Can I point something out, though?
Sure.
Because he was quick to jump on the fact that they were making misstatements about the capital gain tax, but there's still very much an estate tax issue that was avoided there.
How?
Correct. Well, by the estate selling the shares back to him, they don't own them anymore. So that when this person dies, I mean, clearly the cash is still there, but they create a lot more options as far as the tax liability in the future goes. Plus the fact that the shares were not owned by an estate at this point; they were owned by an individual. So the individual did take advantage of a lower capital gains tax rate.
So here's the deal. The problem is there are a lot of details about this story that we don't have, and so it's hard to point out what exactly
because it was a private
place.
transaction, right?
Right.
Yeah.
And so if it went to the estate and it was purchased from the estate or from an individual, then the estate tax would already be due.
Yes.
However, by virtue of Berkshire Hathaway stepping in and purchasing these shares for $131,000 a share, which was actually a little bit of a premium for where they were trading at that point, it makes the whole liquidation problem that people face when it comes to to stocks in an estate kind of go away.
Right.
Which is kind of we could interpret that as Warren Buffett and Berkshire Hathaway looking at whoever this long-term shareholder was, as this person was called out, as kind of a here's our gift to you almost. Now I'm sure that they would take issue with that phraseology, but we could reasonably sort of point that out. If on the other hand the purchase took place, well, I guess it can't really take place because the person's already dead. So it's it's in the estate or in the individual's possession. The fact that it was done now, though, does, if there was an appreciation from the date of death, negate possible higher capital gains taxes that would have been due next year.
We don't know that it was purchased from an estate, do we?
According to the news reports, it was.
I thought it was just purchased from an individual.
It sucks when everybody conceals the real information, doesn't it?
Yeah, it does. Look, I don't think there was anything wrong with what Buffett did. I don't think he was complicit in any sort of thing at all. Clearly, someone wanted to sell appreciated stock that was, so I see what you're saying. He's saying that there was no capital gains tax issue because they received a stepped up basis anyway.
Yes.
Okay. I'm with you. I was a little turned around on that.
But
the details are a little bit sketchy.
I think CNBC is a little turned around on this because if you read some of the reports that they put out about this whole situation, you kind of go, that doesn't sound right.
Yeah. Well, I mean, Buffett's absolutely right, of course, about the fact that an estate doesn't have to deal with any capital gains tax implications anyway.
Right.
Because they received a stepped up basis.
Yes and no. They don't have
to,
providing that they sell immediately. If they wait, then they get stepped up to whatever it was on the date the deceased died. But any gain beyond that is then a capital gain.
Exactly. You're right. I was gonna clarify that as well. So there may have been some gain, but it certainly wasn't as substantial as it would have been.
Right.
If in fact this was an estate that he was purchasing the shares from. The other big problem, like you said, was how do you go into the market and drop $1.2 billion worth of stock into the market?
Well, this is definitely a private transaction. I can't remember what numbered market it is. If we were going through our FINRA licensing exam booklet, we'd be able to call that out a little bit more clearly. But as you know, there's certain numbered markets where certain transactions take place, and this is definitely one of them. So anytime that you have a substantially sized transaction taking place, it doesn't come up on the regular ticker.
The other big thing that he took issue with was that because Kaminsky criticized him and said he was also a hypocrite because Buffett doesn't like stock repurchases.
Right.
He doesn't like buybacks. So, he was attacking him for doing it. I mean, the whole implication was that he was accommodating one of his wealthy shareholders and their requests, and he was making exceptions to things that he's publicly come out against, I guess.
Right. That's the corner they're trying to paint him into, is the fact that he's broken from a little bit of his normal rules because he's got somebody, they allege, who obviously has been in this for a while and has a lot of money in it, that they are kind of throwing the safety floater out to. Right.
But then he, in the email that he sent in response to CNBC, he quoted several times in several different annual reports that he's written for Berkshire Hathaway where he states that, while it's not typical practice and he doesn't typically believe you should do stock buybacks, there are circumstances in where it makes sense.
Yes. He has certainly made the comment in the past that he's regretted most of the ones that he's done. But he has, as you have stated, publicly announced or stated, I guess, I'm using that word too many times, that he does see a reason to do it when it makes sense.
Right.
Which is, of course, when you would do it.
Of course, it's argue. The thing I read about his statements is he doesn't really go into a lot of detail as to what constitutes in his mind a time when it does make good sense. Did you see anything on that? Because I
didn't, and we could go.
The statements that he quoted were just, when it makes sense or when it's prudent or whatever. You would sort of take that to mean whenever you're able to buy them at a discount. But as you stated already, he didn't buy these at a discount.
Correct.
So.
And at the same time, Berkshire Hathaway has basically announced that it is willing at the moment to purchase these shares at a 120% premium when that time seems correct. And that's
right. And he just raised the floor, right?
Yes.
I mean,
it was 110%.
Right. And that was just set last year.
Mm-hmm.
But then they raised it to 120 and immediately did this deal.
Mm-hmm.
So clearly, now that all being said, do I think that from everything I know about Buffett, he would have done the deal if he didn't think it was in Berkshire Hathaway's best interest? Absolutely not. I mean, he certainly believes that by doing this deal, he's benefiting every other shareholder of Berkshire Hathaway.
Right.
So, he certainly thinks that the premium is worth it at this point, which would sort of imply, I'm implying a lot of things, but would imply in his mind that the market price is at a discount.
Yes.
Currently.
Yes. Or there's something coming up in the not too distant future that will force a pretty decent appreciation in Berkshire Hathaway shares.
Right. And he thinks that it was a good use of cash.
Right.
That they had on hand. In other words, there was no other opportunity that he saw that looked better at the moment. And he's sort of famous for that. Like, he's not afraid to sit on cash.
Right.
If he doesn't see something worth buying, he'll sit on it. So I don't know. They've made a mountain out of a molehill, basically, I guess.
You think so?
Who, CNBC?
Well, the naysayers.
CNBC got their butt handed to them.
Well, I think CNBC is sort of the I don't want to relieve them of all their responsibilities, but kind of somewhat of the innocent third party here, right? They just kind of sit there and this conversation takes place, and they immediately backed off as soon as this email rolled in. In fact, they made a public statement saying that they were wrong, and he corrected them, and they let everybody know what the correction was, and they apologized to him for it.
Right.
But when you're Warren Buffett and you lead this tax crusade against wealthy people, do you not have to be unbelievably extra special sure that you don't do anything that can be construed in a way that is tax dodging?
I would think so. I mean, I think you sort of have to be above reproach, right?
Right. I mean, I have long time stated that as much as I like Warren Buffett, I think that if he weren't sort of dangling around the richest man in the world category, he wouldn't be as vehemently in favor of raising taxes as he is.
Right.
I mean, once you've gotten to the point where you've got not just a couple billion, but several tens of billions of dollars in your possession, paying taxes really doesn't matter anymore, especially on a yearly basis.
It's not so much a big deal, huh?
Mm-mm.
He's very much in favor of increasing the estate tax as well.
Right.
He really is against passing money to, to the next generation or to subsequent generations, which, I mean, he's sort of, as evidence of that in his own estate plan, I guess.
Right.
The fact that he's, 99% of all of his money goes to charity, or 100% of all of his money goes to charity when he dies.
Right. Well, if he wanted to drop 1% or 1/10 of 1% on me, I'd take it.
I was about to say I'd be okay, right?
Yeah. I'd get over the not having all of it pretty quickly.
Yeah. Yeah, I think so.
All right, enough of Warren and all of that stuff, and now we're on to something that really is potentially even more shocking than a Buffett-CNBC breakup. You're
what could
supposed
be
to
more
say,
shocking
"What's
than that?" I was getting around to it.
I was getting around to it. I was leaning forward in my comfy sleeper chair.
Yeah, I was starting to doze off.
Yeah, for those of you who don't know, he's sitting in some kind of weird overstuffed wingback chair now.
Fully kicked back with microphone, sort of rigged up, sitting in a drawer.
For those of you who don't know, nobody knows with me, I guess, and Brantley, we had to wait like 15 minutes as he tried to sort himself out right before this started.
And for the trains to pass, so that you wouldn't hear the loud, obnoxious horn of the trains passing through downtown Fort Valley.
All right, so FINRA does something that is shockingly reasonable.
Yes, which is completely unbelievable. For those of you who don't know what FINRA is, it's the Financial Industry Regulatory Authority, and it's the self-governing body for the investment industry. Is that the best way to put it?
Well, we call those self-regulating organizations, don't we?
SROs.
Yes.
Yeah.
Yeah, so
but before we throw out too many acronyms.
It's the policing wing of the financial services industry for the retail side of this business. So the advisor that you have who either sells you a mutual fund or puts you in managed money or sells you stocks or bonds, he or she answers to FINRA.
Right.
In addition to the Securities and Exchange Commission if he or she makes a really big mistake. So what they did was earlier in the year, FINRA basically established a suitability standard that said anybody who asks you about any possible investment idea, doesn't matter if they become a client or not, doesn't matter if the product is a registered product or a product that your broker-dealer or a registered investment advisor is going to make money on, anything that you discuss with anybody is subject to the suitability rule, so don't mess it up.
So anything you can say, anything you say can and will be used against you in a court of arbitration.
Yes.
Yeah, I mean, it was completely ridiculous because, I mean, this has included crazy things like, someone asked you about something at a cocktail party.
Right. And if they act on it and then want to come back and cause an issue, they could.
Whether they were a client of yours or not.
Mm-hmm.
Completely insane.
Mm-hmm. So recently, FINRA came back out and said, all right, listen, maybe we were a little too overbearing on that one. And so,
because all the member firms went nuts.
Well, they went nuts because they had to have unbelievable compliance resources in order to police this thing.
And how do you police that? I mean, you can't.
You have to have your talking points pre-approved by your compliance officer before you go to that cocktail party on Friday.
Exactly. Don't say this. You can say this. Yeah.
I'm holding a guaranteed cocktail party. Can I do that? That word
Probably
can't
not.
exist.
If I was drinking at the cocktail party, does that still count as advice? Because
you need to get the liquor pre-approved by your compliance officer.
Exactly. Anyway, I didn't mean to derail.
No, that's okay. So basically, what FINRA did was say, all right, listen, if they don't become a client, and or it's a product for which your firm, either your broker-dealer or your registered investment advisor, does not get compensated, then it no longer applies to this suitability rule.
Right. So that means what? I mean, in terms of products, we talk about like fixed life insurance sort of things, fixed annuities.
Correct. So if somebody
non-regulated products.
Right. So basically you look at it as non-regulated products. If somebody comes up to you and they ask you a question about buying cash value life insurance or buying an indexed annuity, and you tell them it's a bad idea, or you tell them it's a good idea but it's not really something that I do, so go talk to this person. Or even if you say, yeah, it's a great idea, and I'm a licensed insurance agent, so I will sell you that whole life policy. At that point, it's not subject to your compliance officer according to this specific rule.
Right. But we know that some compliance officers will still love to talk about it.
Well, yes, and in fact, they're to sort of paint the picture of FINRA in its ridiculousness. Mark Menschel, who is a currently just a general counsel, but he used to be he used to be.
No, he has his own firm now, but he was the general counsel
used to be
for
general
regulation
counsel for FINRA.
Yeah, at FINRA, yeah.
He looks at it and says, I don't think it's internally consistent.
He doesn't like it, huh?
No.
He wants it back the way it was.
Yes.
Good thing he doesn't work there anymore.
Well, he also points out that, what's the rule?
The just and equitable principles of trade under Rule 2010.
There you go. According to that, FINRA, if they want to really push the issue and look for enough evidence that you violated it, they can still get you.
Yeah, of course. Well, and here's the dirty little secret, right? I'm just going to bring it out and put it on the table. All the companies want to regulate and talk and I'm not talking about FINRA, but I'm talking about FINRA member firms, right? Broker dealers. They very much want to have authority over what you talk about and what you don't talk about, because they don't want you talking about things that they don't get compensated for anyway.
Right. If we don't have it, you don't need to talk about it.
Right. They want you talking about things that they get compensated for, and they very much would like to stonewall you from everything else. That's just the truth of the matter. Suitability be damned.
Right. Well, I was going to ask you what you think this new decision from FINRA means for some of the broker-dealers that have railed against certain insurance products and telling their members that they can't sell them because They don't have them. They don't have they don't have the ability to monitor them, and therefore they're not allowed to sell them.
Right. Well, I don't think it means anything at all, because that's the other part of the other side of the coin, is that the firms themselves can individually decide above and beyond what the FINRA statutes are, what they will allow or disallow their reps to talk about or to sell.
So basically, to the smart rep who can now point out, well, you can't hide behind FINRA reg for that. They're just going to go, shut up, we're going to do it anyway.
I think they've done that for years.
Yeah.
They were regulating. There were some broker dealers that were regulating fixed indexed annuities in particular before there was any guidance from FINRA on it at all.
Mm-hmm.
I know one that I dealt with in particular had even though none of the fixed indexed annuity business went directly through them, they had an approved list, or actually they had a vendor that you had to use, and they had an approved list from that vendor of the products that you could use. So it wasn't the entire universe of products that you were allowed to sell. It was the products that compliance had been through and individually selected as being the ones that you could sell.
Right.
Even though it wasn't a regulated product. At that point, there was no guidance at all from FINRA. I mean, this was years ago.
Well, there really still isn't.
Not so much.
That piece of legislation died and
was killed, right?
Right.
Yeah. Back a couple years ago. But they're very much still involved in that business, whether the regulatory agency says they have to be or not.
Here's a quote on this ruling, and I just want to read this word for word. So it specifically spells out the fact that now these products are no longer under the scope of the suitability rule, and people who don't become clients aren't subject to the suitability rule. However, a firm's suitability analysis also must be informed by a general understanding of the non-security component of the recommended investment strategy. That's a direct quote from FINRA, as it stated, we're going to change the rules. However, there's this little piece.
Mm-hmm. Which to me, that says that the firm's still responsible for making sure that any non-regulated business that they still understand what's going on.
Right.
Like, in other words, that they're still in the loop.
Yes. So under the outside business activity, it's stated and they know about it.
Right. Because that's the thing you can never forget about FINRA, is that FINRA is funded by its member firms.
Right.
So it's always in their best interest to keep you from doing any business outside of them.
Right.
That's just, it's just the way it is.
We don't have it. You don't
need to sell it. Exactly. And if you are selling it, we want to know how much of it you're selling.
Because if it's too much, we're going to have a fit. We're
going to have a cow. We're not saying anything. I hope this is not news to people, but it may be to some.
There's people out there going,
it's just
oh,
the truth
crap.
of the matter. It's just the truth.
Yes.
That was the reason the FINRA wanted to regulate the fixed index annuity business, was because broker dealers were squawking about the fact that there was too much money. They were losing too much money from the sale of these products. And if they was brought under regulation, that means that it would have to be brought into their commission structure, and they would get a piece of the action.
All those agents.
That's all it was about.
We're out there saying, hey, there's a product that actually is guaranteed to a certain degree, and you don't really lose money in it as long as you stay in within a certain period of time. And people said, hey, that sounds kind of attractive, and it's paying better than some of the fixed stuff that's out there. And so it kind of exploded, and brokers were selling a bunch of it, and they also realized that, hey, this doesn't have to flow through the broker-dealer. I don't have to take a haircut.
Yeah, I don't have to give them 50% of my commission.
I like this stuff. And all of a sudden, all the broker-dealers said, wait a minute, we're not making any money.
Yeah. So I think we need to regulate that product so we can get a piece of that action.
You may not be selling it right. We have to help you out. Just send it to us, and we'll charge you 50% of whatever you make.
To have our lawyers who have never sold anything tell you how to offer this product. Wow. But never fear, Brandon. Never fear. Because in a recent survey in 2012, clients are not overly impressed by their advisors.
Really?
That's what the survey says.
That's a shock.
Really?
Well, you couldn't hear the sarcasm in my voice.
I detected a hint of it.
Well, there have been statistics out for a long time that have hinted at the idea that probably close to a majority, if not a majority, of people would be willing to leave their advisor if they found a reasonable alternative.
What would a reasonable alternative be? Not have one?
Well, there are people who've gone that route, right? Like that's what gets
Sure.
T. Rowe Price and Fidelity and those kinds of people off the ground.
Right. Absolutely.
So the hard and fast numbers for those who want to know, 43% of those surveyed said that they do not feel their advisor has earned his or her keep in 2012.
It's interesting. I wish they had delineated whether these people were, fee-based advisors or commission-based advisors. They didn't give us any information on that.
I would assume that for by and large, we're talking probably managed money.
Yeah,
And
I would think so, right?
if not managed money, then heavy mutual fund use.
Right.
They do mention that of those who said that they kind of looked at those who were happy, those who weren't happy, and noted that 2/3 of investors who liked their advisor said that they'd switch with them if they left firms. Only about 1/3 of people who were asked said that they'd be willing to do that if their advisor left and switched to a different firm. So there's that sort of idea that if they've got your money, they're either using some heavy
Right.
managed products or they're doing a fee wrap account type deal.
Why do you think people are so disappointed?
My knee-jerk response to that kind of question would be customer service by and large.
Right.
There's always going to be the person who's upset about losing money, but the truth
Sure.
is, and we may break new ground here, nobody, I don't care who they are, has the ability to avoid that.
Right.
And so when you're heavy in equities or something along those lines, you're going to have good days and bad days. And the only way that I'm aware of to mitigate the effects of a bad day as an advisor is to make sure that you're available.
So I shouldn't crawl under my desk into a little ball and
No, and
hide,
you
or...
probably shouldn't tell your secretary to hold all your phone calls.
Not that ever happens. I'm just saying.
Never.
Well, because, yeah, I mean, one of the things is it just I guess when I was looking at this, I was thinking, is it an expectation problem from clients, or is it really a service issue from advisors, And there were a couple of other statistics, I didn't mark the specific numbers, but there was a big percentage of the people who they surveyed that wanted to hear from their advisor when the market started to go south.
Yeah, about 60%.
And I started thinking to myself back when I used to work inside of a full-fledged, what you'd call brokerage operation, about some of the guys who'd been there for years and years. I mean, I'm not talking about those of us that were relatively new, but I'm talking about the guys that had, had practices in place for 15, 20 years. How many clients they had. I mean, it would have been almost impossible for them to contact. If I thought about if they were on a day the market went south, they needed to contact 60%. I'm just using the numbers, If they were to try to contact 60% of their clients, it would have been impossible.
Well,
I mean, some of these guys had 2,000 clients, and
I think there are people who can realistically understand that, but at the same time, one of the things that will make or break you, and I think you and I would be willing to sing amazing praises for this, is your ability to grasp technology.
Right.
And so if you've got 1,000 clients, let's say, that's a big number, but let's say you do, and typically if you do, you've got staff. You've got to have a vast majority of those clients' email addresses.
Yes.
And so if you are heavy in the equity game and you know there are possibilities that days could come where you've got to explain why today your recommendations yesterday were wrong,
Right.
you've got to have kind of the emergency preparedness system in place that says when this day comes, we don't know exactly what we're going to say, but I know that I'm not going to be out prospecting or playing golf. I'm going to be typing this email, and I know the list that it's going to go to.
You better have it done early in the day so you could get compliance to approve it before you need to send it out. Now, I mean, I guess my bigger point is just, I think there's still a big gap between what advisors are capable of actually doing and what clients expect them to do.
Uh-huh.
I really do. I think there's a big gap there, because in reality, if an advisor has 1,000 clients, it's going to be really hard for him to contact. The only way advisors who really can have the high touch that people want to have is that they have to have a handful or a smaller group of really wealthy clients.
Right.
You know, the guy who has 100 clients, but maybe the average investable assets of each one of those clients is a couple $1,000,000, you know, then he can sort of that's a much more manageable practice, right?
Mm-hmm.
But typically, a lot of times, the people in the survey, they said it was particularly high among like the Gen X and Gen Y. Clients wanted to have a higher touch, so to speak.
Yes.
That's really tough. I mean, I understand both sides, I guess, is what I'm getting at. I completely understand what the clients are saying, and I believe that they ought to be serviced in a better way. But I'm also, I guess I say the disconnect is from an industry standpoint. I don't think the industry has moved in a way that it can really accommodate what people want. There seems to be a big gap there.
Let me play devil's advocate for a second with you, though. And let's ignore for a second like an email that goes out that speaks specifically to what's going on. Can we not make the case, and I think that, well, hold on. Can we not make the case that it's very possible that just a boilerplate email that goes out that says, listen, something happened. I know. I'm aware. And I'm here. And
that might make an impact to some degree, right?
You know, if you call, there's a good chance it might be busy because you're not the only one. But, you know, I'll get to you. And so just be mindful of the fact that showing the people that when the market is crashing, you're not out playing golf or hanging out at some party or something along those lines. Making people very well
with
aware
Lady that you're not with Lady Doula. Is that what you're? With
your dollar coins?
Yeah.
Well, actually, you need 5s for her, right?
Yeah, $5 coins.
So, you know, you've got to at least let these people know that, one, you're on it, and two, you're thinking of them.
Right. I agree. I mean, to a certain extent, I think you're right. There's a certain number of people that would be satisfied with that.
I wonder what strippers think of their financial advisors.
I bet someone's covering that story. I don't know. I just think the model is still broken.
Well, is there another question to be asked or another point to be made that is know your client?
Yeah.
In other words, feel out the ones who are needy. And I don't say that pejoratively. I just say that to, the ones that like the contact versus the ones who really aren't all that affected by it one way or the other. And make sure that when things go badly that you are, triaging these things. And you want to get out to everybody, but the ones who it really, really matters to are the ones that you reach out to immediately.
Sure.
And at the same time, I think that there's something to be said of the client who remains somewhat cynical of all the people they speak to who are advisors of anything.
Right.
Because you should have a willingness to challenge your advisor, whether it be your financial advisor, your legal advisor, your accountant, your doctor, whatever, and be willing to say, well, wait a minute, not everybody knows everything, and no one's perfect. So why would you want to be in a position where you are always happy with this person?
Mm-hmm.
Because I think that leads into a situation where you start to make mistakes.
Right.
Just my thought.
No, I agree with you. I agree with you. And I mean, the people who responded to the survey that said they were most happy, I guess, were listed that, you know, one of the things I thought was there were several factors.
That ugly word holistic came up.
Yeah, I was like, what does that mean? Does that mean we never mind, I'm not going to get into that. Does that mean I get a massage and some Reiki therapy or something when I go to? We have aromatherapy sessions in my financial advisor's office. That's really weird to me. But anyway, I think what they're trying to say is that maybe they're the kind of advisors that are giving them more advice than just specifically about their investments. Maybe they're getting some financial coaching type stuff, I think.
Right.
I think that's how it's intended. But one of the things they listed is that these advisors embrace the use of technology.
Yeah, so, I did see that, and I was actually going to say, we talked about this last week, that you know, having a grasp of technology and embracing modernity can really pay dividends.
Yeah, clients like that. I mean, a lot, like you said, I mean, some people would just prefer you send them an email every now and then.
Mm-hmm.
And from time to time, maybe even a personal email.
Yeah, not a generic one that just says, "Hey, Bill, how you doing?"
Exactly. Haven't talked to you in a while. Hope everything's going okay. Whatever.
And here's the thing. Experience here. I'm going to speak from experience. Sometimes they won't reply.
Yeah.
Doesn't mean they don't like you. It just means they're busy.
Right.
Don't freak out about it.
Yep.
And also don't think that means I don't have to email them anymore.
Yeah. That doesn't let me off the hook. Because last time they didn't reply. Not so much, huh?
No. Speaking of things that might frustrate clients, if anyone out there has noticed that their advisor, especially for a big-name firm like Morgan Stanley or Merrill Lynch, has suddenly become unbelievably obsessed with talking about mutual funds and lending products and insurance products, we might have a good answer for why that is.
Why is that, Brandon?
Well, it turns out that both companies have kind of readjusted their compensation plans, not from an exact standpoint, like what they're paying out in terms of the grid, even though if you're a non-industry person, you probably have no idea what that means. But from a bonus standpoint, they're saying that there's now a much bigger emphasis being placed on the sale of what they refer to as strategic assets, which are further defined as reoccurring fee revenue generating assets. Which we
sounds to me, that's kind of funny,
sounds ugly,
Brandon.
doesn't it?
It sounds like one of those things that's like, well, it's strategic for somebody. Probably not you.
Strategic for our staying plan.
It's strategic for our firm's bottom line.
Yes, these things include mutual funds, alternative investments, trust offerings, mortgage products or lending products, deposit accounts like CDs, and what they define as annuitized products, such as insurance, broadly defined.
Yeah, that was very broadly defined.
Items that are not strategic assets, stocks, and bonds. We could probably also put puts and calls in there.
Yeah, I would guess so. Anything that would be transactional in nature, right?
Mm-hmm.
Well, although, I mean, mortgages are very transactional.
Well, you'd think so, but they're bank products where they get to collect all kinds of fees and collect interest and then sell it on the secondary market for a steal, so, you know.
Right. And there's not a lot of fee disclosure and transparency in those products.
No
either,
point.
so.
Why ask?
Right.
But this announcement has frustrated some of the legacy members of Morgan Stanley and Merrill Lynch because they remember the good old days when you could have one client call you up and say, I want to sell 20,000 shares of GE, and you just said, okay, hold on. You hung up the phone. You called up client B, and you said, hey, guess what? I got a great deal for you. And you could do that all day long.
Right.
Now, however, they're going to be forced to go out and find new money and put it in mutual funds.
Or other strategic assets.
Yeah.
And their the big thing was, like you said, they're not changing their comp plan dollar for dollar, but what they're telling the advisors is, hey, if you want your bonuses,
yeah.
And I'm not going to get into like the nitty gritty of how they figure out their bonuses, but if you want your bonuses, then you have to sell these products.
Right.
Like, you know, if you bring in $10 million in new assets next year, your bonus structure is basically the same, except that if it's $10 million of stocks and bonds, we're not going to give you so much of a bonus.
Right. You're not going to make anything.
Right. You're going to get incentivized to sell the products that we want you to sell.
Mm-hmm.
And I think this is sort of funny, right? Because didn't we just spend 10 minutes talking about suitability?
Didn't we also just spend like a long time talking about whether or not people like their advisors?
Yeah, exactly. I mean, it always seemed funny to me that out of one side, the regulatory body would tell you can only sell things that are suitable to your client. And then out of the other side, you come out of a sales meeting where the sales manager told you, I want you to sell A, B, and C.
Let's put lipstick on this pig.
Exactly. So, so my thing was always, I just ignored the sales manager, which always made me number one on the list.
Did what was right. Number one on the list for going tomorrow.
Yeah. Number one on the list of guys the sales manager hates. Because, when he would walk in and say, I need you got to sell some of these muni bonds, get on the phone and start calling your clients. I'd go, yeah, okay, I'll get right on that.
I called a bunch of them. They don't want them.
Yeah. I'd call the 2 or 3 people that I thought that would actually benefit from it, perhaps, and talk to them about it. And
they were like, nah.
So it's always funny to me that they're able to do this sort of thing, Well, they're really able to really twist the arms of their reps to sell particular products when their reps on the flip side are held to this standard to make sure that everything that they sell is suitable.
We've commented on numerous different occasions the fact that a lot of the people who get into this industry are salespeople, and so they're not really doing this for the advisor side of it. They're doing it for the look how much money I can make selling products to people side.
Right.
And so this is one of those examples, in my opinion, where your stomach kind of has a bit of a weird churning feeling in it as you read through this stuff, and you go, oh my God, these people are going to start making these recommendations, and the only reason they're going to make it is because they're looking at their bottom line.
Exactly. And the only reason the company is pushing to do it is because they're looking for their bottom line.
And the problem is this industry hides behind this facade of being an advisor, and it kind of woos people in on the idea that now we're gonna help you sort this whole thing out, whatever the problem may be, retirement, college savings, you name it. And what happens is it's all a matter of what strategic asset can I wedge in here most reasonably to make the money that I need to make, but also qualify for whatever kind of counsel or bonus I'm trying to get done this month, week, year, whatever.
Right. It's not an advisory role at all.
No.
Because it's, I've got these 3 products. Let me see how I can wedge everyone into them.
Mm-hmm.
Because I only need 50,000 more assets to hit the chairman's council.
Right. Now everybody's going to hear about this mutual
and then I get a
fund.
10 basis point bump in my bonus.
Mm-hmm.
It doesn't compute for me. It never did when I was a part of it.
So do we believe that these kinds of moves are going to kill the stock and bond transactions at the trading desks for places like Morgan and Merrill, and we're going to see...
They already have.
Yeah, okay.
I mean, it's dead. That business is dead. I mean, to a certain extent, the discount brokers killed that business.
Right.
I mean, why would you buy 1,000 shares of GE from a broker at Merrill and pay him $800 when you can buy 1,000 shares of GE from Scott Trade for $7?
Yeah.
I mean, what's the guy adding to your transaction?
He might send you a birthday card.
Maybe even call you once a year.
Maybe an email when the markets go bad.
If you're big enough, you might get a turkey.
Well, can't be any more than $100.
That's right. It's got to be a turkey breast. Can't be one of those honey baked deals. That'd put you over the top.
I'd buy Omaha steaks, but sorry, I just, that was always a convenient excuse back in the I don't know if you did this, but back when I'm still securities licensed, but I'm not really doing anything with it. You get the family members for the holidays who are like, what are you getting me? It's like, well, nothing that costs more than $100 because FINRA says I can't.
I'd apply it to every aspect of my life.
Hey, they did earlier.
They said anything you do.
Mm-hmm.
No matter where you are.
Mm-hmm. I'm just listening to Mr. Menschel or whatever his name was. They apply the rules when they're convenient to them. I can do that too.
Well, if it's any consolation, there seems to be, you know, the guys that there was a quote in the story from a Merrill advisor who wants to remain anonymous. Imagine that.
Really? He must have been there for a long, long time.
He obviously doesn't want to find his daughter's pony's head in the bed next to him tomorrow morning. But he says, I've referred a lot of clients for mortgage loans, but I don't agree with activity goals. The bank needs to make offerings so compelling that clients knock on my door asking about them. I thought that was like the best thing I've ever heard, because that's what you and I say, those sort of comments all the time.
Well, right. I mean,
like if you want to win, just be better than everybody else. I mean, that's how you win.
Mm-hmm.
You know, we don't pick favorites.
We have a very weird niche focus now, but we used to be more spread out in the finance world and you know, have sold our fair share of mutual funds and variable annuities and other registered products. But nowadays we play a different game. And when people ask us kind of what companies we like, the answer is, well, when we put them through a spreadsheet, the one that's on top.
Right. I mean, I don't play favorites.
And as soon as that company stops doing whatever it is they're doing that makes them good, we move on to the next one.
Right. I mean, I guess you could say we have a short list, sort of, depending on what the situation is. But that's just through analysis that we've sort of narrowed it down to the companies that are going to be competitive at a particular niche, right?
And sometimes there are surprises.
But we don't play favorites in terms of, well, you know, we're only so far away from hitting the chairman's council,
right?
So that I can go on that trip to Hawaii with all those other agents. Oh boy.
Yes, because as people can tell, a sect of people who love us immensely are other agents. So we just want to hang out with them as much as possible.
Those company home office people really love us.
Yeah, they do.
And their attorneys too.
That reminds me, I was going to ask you what you thought of FINRA's rule as it applied to people who are not registered reps. But I forgot.
I don't think anything of it at all.
I bet we could ask the home office of a certain company what they think and get a different answer.
Probably so. But it, you know, going back to this story, I think that, you know, to me, that's the bottom line. If your company wants to compete and you want to do more mortgages, I'm just going to pick that as a product. But if you want to write more mortgage business than everyone else, then make your mortgages better than everyone else's.
Well, we say that, but you know that every company out there and every sales manager out there shaking his head going, those idiots, they're such idealists. We know that salespeople exist to do one thing, and that's create demand. It's all about going out there and talking about the good points and ignoring the bad ones and making people think that what you've got is what they need and it's the best thing out there.
Right.
So in other words, we just really hate salespeople.
We're not very good at it, are we?
Yeah, we suck at it, so, you know.
I mean, we're so bad at convincing people that they should do things.
They get mad, right? Like, which one should I do? I don't know. It doesn't matter. Which one should I do? It really doesn't matter. Pick one.
Pick one. I spent so many years trying to convince people to do things. We've had this conversation before.
You have to do it, and you have to do it now.
We just don't do that anymore.
No. Funny thing happens when you adopt that, you make more money.
Well, and I think, you know, this Merrill broker advisor who made this quote, I sort of feel like he's probably of the same camp, you know. He's a guy who's been around a while, and he says, look, you know, I recommend people look at the products, but I'm not going to I'm not going to apply some unreasonable pressure when, you know, they go and talk to our mortgage people and our fees are higher and our interest rates are higher than the guys over at Chase, you know.
Mm-hmm.
I mean, Chase is going to win.
He's not going to tell him the story about how his company's better because it's been around for so many years, and he's been to the home office and he's had those conversations with the guys who design these products, and
he has seen it.
And let me tell you, those people, they have families. They go home every night and they do what they do every day for their people. And you know, okay, I think you get the point.
So does everyone else.
Yeah.
Yeah, exactly.
I have to pay $1,000 more. Don't care about him and his family. I'm going to go to the next guy.
I care about me and mine. My family could save the $1,000.
Here's the deal. Here's the deal. That other guy at the other company who designed it, he's probably got family too.
Right. Exactly. It's craziness, but it seems to be. Well, we know that it's a big trend, and they went on and on and on about all the different compensation and bonus plans too in the story. Oh
God! To the point where it was just like, you know what, we're going to skip that part.
I don't even know what that had to do with anything, but bottom line is you're not going to get paid as much if you don't sell what we want you to sell.
Yes, so they're going to talk more about products that you might not need or want
for that matter. So if you find that they are getting awful pushy about refining your house or anything, then you should immediately remember back to this episode when we say, we told you so. It was coming.
Do you have a mortgage? Yes. What is it? You need to refi.
You need to refi that.
But I'm underwater. You need to refi.
Exactly.
Your kids have a mortgage? I need to sell 8 more before the end of the year.
I need my bonus. Well, Brandon, I think we have sufficiently beat this horse.
Yeah, if we had more time, we'd dive into why the holistic thing is a joke. Maybe some other time. It's apropos. I mean, we've got situations like suitability and the whole advisor thing and why people hate their advisor. And I think there's sort of a misnomer in that concept, but we really don't have time.
Not today.
So with that, I am Brandon Roberts.
And I'm Brantley Whitley.
And next time, holistic is a joke.